All right, folks, welcome back. All right, so NASDAQ daily chart for June 2022. And here we have Friday's trading. Friday, Thursday, Wednesday, Tuesday, Monday. So we had a nice little decline down in this week. And then Friday, we have somewhat of a retracement. So these relative equal highs, that's what I'm looking at. So I'm thinking that it could draw there. Now, the draw on liquidity does not need to be traded to have a profitable framework or setup. So what do I mean by that? Well, if we're below this objective, and I'm thinking, and if it was you thinking the same thing, if you think that the market's going to draw up to that level, whether it be today or into next week, you look for a setup that will allow you some kind of participation in this expansion towards that. It doesn't need to get there, as you'll soon see. We're going to drop down into the hourly chart. All right, so here's the hourly chart. You can see relative equal highs up in here. Look at the high of that candle there. That's the 12,553 and a quarter level. Okay, so that's what I'm framing it on. And we traded down, started to run higher with a shift in market structure here. And then just notice how we have had this low, swept. We came down below it, came back above these relative equal lows, and then we came back down. Tried one more time to go lower and then rejected it. Notice that? So as the market's starting to trade higher, where is it likely to go? Well, we've already taken out a large pool of liquidity below these relative equal lows. This is sell side. Now we're back above these relative equal lows. So where's buy side? Clear and obviously right here. Okay, not really obvious in terms of any imbalance in here because we already rebalanced this area there. So there's nothing really all that exciting except for that small little section there. So if it's going to go up to this area here, my thought process is that it's likely to probably just punch through and take the buy stops resting above here. So that's the draw on liquidity. Just think of it like a big magnet drawing price up towards it. Okay, so we're going to drop down into a 15-minute time frame. All right, so here's the 15-minute time frame. So we have the market trade here, lower, low, low. So this right here may trip you up, but this right here was the 9:30 in the morning manipulation where it takes out this overnight London low, creates the manipulation idea, then rallies. And then the retracement in here in the afternoon, that's what I was looking for. So I wanted to see that type of idea. All right, so here's the 5-minute chart. Here's the overnight London lows, 9:30, we run through it, taking out the sell side here, and then it starts to rally. The market trades lower, down into the range between this low in this high. What is it trading to? Discount. So I'm going to go into this area a little bit tighter. Okay, so we can see here's our consolidation. It drops down, creates the low of the day, power 3. So it's accumulating long positions, manipulating early longs out of the market, taking out the stops overnight, then rallying, and then I'm looking for the continuation up to take out the relative equal highs here because I think I'm still going to see continuation in the afternoon. So I want to buy this discount market, and I'm going to be buying inside of this fair value gap because it's at or below equilibrium between this low and that high. All right, so I've added the annotations here. All right, so we have the New York session open at 9:30 in the morning, New York local time. Creates the low of the day, rallies, creates the high here. It's 12:10. That's that lunch time. Remember I told you it creates usually a retracement of some sort or consolidation. Then it retraces lower. And then here is 1:30, right about there. So at 1:30, the algorithm will start seeking liquidity. If it's going to continue higher, what's it likely to do? Seek sell side. So where's sell side? Well, we have relative equal lows here, but is that a discount from here to here? So this dashed line here that's in purple, I have that noted as equilibrium. That's essentially the same thing as if taking the fib from here to here, and that's 50%. The market drops down into equilibrium and then below it into the fair value gap here. This candle's high, this candle's low. That's your imbalance. Fair value gap is here. So the market drops down into it here at 2 o'clock in the afternoon, and then displacement. Okay, we'll see this fair value gap on the lower time frames. I'm going to go through and let you see it. But this displacement on the outside is a shift in market structure. In a day that's likely to be bullish, is counter trend to a higher time frame. We're working with the logic that it's probably going to be a retracement because we've been down for a long time now, and most people are probably going to want to get out over the weekend. So the algorithm's going to start squeezing on them to get their positions squared before close of the Friday. So we're going to drop down into a 4-minute chart. No fair value gap shown here except for this small little area there. Now by itself, that's possible. We get a small little return into it there. I'm not looking at that. Okay. Go down into a 3-minute chart. There's a gap there. Again, you can see that candle right there. That would be fine if that's what you're looking for. And then 2-minute chart. All right, so we have down close candles in here, order block, fair value gap. This candle's low, this candle's high. There's our imbalance, order block. It trades down, drops into that. I want you to look at how the market created this counter trend idea, but still using my fair value gap principle and concept. Liquidity was above here. The day was bullish. The algorithm kept pricing higher and higher and higher, and the logic was delivered here.